Hi, folks. Thanks for joining us tonight. For tonight's 6 o'clock session, we're going to learn about applying for a mortgage. We've got a great presenter here tonight for you, Chase Cusack with First Home Mortgage. My name is Scott Serafin. I am the business development specialist at Live Baltimore, which means that I work with our real estate community here in the city and provide them with benefits such as teaching tonight's class, helping to connect them with customers like you, when it comes to buying a house here in the city. So I'm going to host tonight. I'm not going to be the presenter, but just as a little background about myself, before coming to Live Baltimore, I was actually a mortgage lender for almost 10 years. So I'll actually be fielding some of your questions tonight. While the presentation is going on, if you do have questions, in the top right corner, you'll see a button that's called Q&A. You can just type them in there. You'll either have myself answering them, or if I can't answer them, we'll take some time at the end of the presentation where Chase will cover them live. So just a few other notes. If you do want to be able to make sure that you're viewing your screen properly, then you'll want to make sure you go onto full screen mode. There should be a button there for full screen mode, so you select that. There is no chat box, so if you do want to talk to us or say anything, you'll have to go on to the Q&A box. There is going to be a recording for tonight, so if you do want a copy of that, we can send that out afterwards. And you'll also receive a survey. As soon as we end the meeting, you'll get an email just asking you some of your thoughts, what you thought about it. And if you could fill that out for a couple minutes, that really helps us out as we go forward. So with that said, I'm going to turn things over to our presenter, Chase Cusack. He's going to do a quick intro, and then he'll get started. There you go, Chase.
Awesome. Thanks, Scott. As he mentioned, my name's Chase Cusack. I'm with First Home Mortgage. Excited to be doing this presentation tonight. I know it's a little bit different, so I appreciate everyone jumping online with us. Typically, I like these presentations to be maybe a little bit more interactive, but considering that we're doing this virtually, the plan is to go through the presentation, and as Scott mentioned, there's a Q&A box for you to add your questions into. So I'm going to do the presentation, put your questions in there as you go. Feel free to take notes, and we can start to take care of some of the questions at the end. So for the time being, I'm going to turn off my video so that we can focus on the presentation, and I'll go ahead and get started. Thanks. All right. So again, and my contact information will be at the end if you want to follow up with me towards the end. But like I said, I'm with First Home Mortgage. I'm a loan officer with them, meaning the person that you would apply with the mortgage for, and I coach you through the process and get you to that closing table. So right off the bat, everyone's here, so they probably have some interest in owning a home. A lot of people, it's an American dream. It's what a lot of people strive for. But some of the added benefits is it's one of the safest long-term investments. And what that means is, instead of paying rent each month, where essentially you're paying your landlord's mortgage, when you take out a loan and you buy a home and you pay down that mortgage, you're paying down the loan, and that home is an asset that you own. And as the slide mentioned, it's one of the safest long-term investments as you build equity in your home, whether that's you sell the home down the road to buy your next one, or take out a loan against that home, whatever it might be, tends to be one of the safest long-term investments. When you own your home, you have the freedom to remodel, improve, and redecorate your home. There's no landlord restrictions, anything like that. It is your home, and you get to do with it as you please. There are tax advantages to owning a home as well. I'm not an accountant, so if you want to get down to the nitty and gritty, you might want to talk to a licensed accountant. But the mortgage interest that you pay on a home is a tax deductible, and so are the property taxes. So each year when you're filling out your annual tax returns, it helps you get a little bit more money back. And of course, the stability, owning your home, there's no lease end, having to move, being forced to make changes. That's your home, you own it, and unless you want to leave and sell that home, you don't have to. So what goes into getting a mortgage? That's what we're going to cover mostly tonight. There's three main components that go into a mortgage that we're going to spend some time on. These are the three most important things that a lender looks at. They are credit, income, and assets. So the next few slides will kind of go into these in more detail and what it takes to get a mortgage. So I'll start first and foremost with credit score. As the slide says, it's probably the most important thing that a lender will look at. A credit score can range anywhere from 300 to 850. It says 850 on the slide, but don't feel alarmed. Really, no one has a perfect credit score. 850 isn't really seen of. Most mortgage lenders want to see your score above 600. Usually, the better your score is, that might open up more opportunities for some different type of loans, make you eligible for different financing options. So I'd say 600 is about the minimum that most lenders will look for. And once you get up to about 720, 740, you're kind of in that top tier range. Doesn't get much better than that. So don't stress if you don't have an 800 credit score or a perfect credit score. If you're over 600, you can start to look at some financing and you have those options available to you. There are 3, we call them credit bureaus, that report your credit score. Those are Experian, Equifax, and TransUnion. And each one is going to give the lender a little bit different credit score. They're usually within the same ballpark, same range, but they're never the exact same numbers. Each credit bureau has a little bit different scoring model, how they calculate those scores and come up with a number. So don't be surprised if your Experian is 715 and your Equifax is 725. Sometimes there's some variance between those numbers. And what the lender will do is they'll look at the middle score, and that will be your qualifying credit score for the loan. They don't take an average, they just look at that middle number. So where to find it? A lot of people have probably gone on Credit Karma or other sites like that that provide credit reporting, or maybe your credit card or your bank offers some kind of credit reporting. That's a really good place to start and get an idea of where your credit score might be. But really, to find out exactly what your credit score is, you want to talk to a loan officer, a mortgage loan officer. And the reason for that is you will get a different credit score depending on if you're applying for a car loan, maybe trying to open up a credit card, or in this case, apply for a mortgage. There's different scoring models for each type of credit that's given. So if you were to go to a car dealership and ask them what your credit score is, that number might be different than what a mortgage loan officer would pull. So like I said, a website like Credit Karma is good to kind of get you started and have an idea of where it is. But to find out where your mortgage credit score is, you want to make sure you talk to a mortgage loan officer. In the graphic over here on the right, it covers what goes into a credit score. So if all these numbers you look around, it adds up to 100%, and it kind of shows you what the importance is of each factor in determining that credit score. So probably to no big surprise, the most important thing when coming up with a credit score is your payment history. That means paying your bills on time, no late payments, accounts not going into collection, things like that. It's making that monthly payment on credit cards, car loans, student loans, a mortgage, whatever it might be, making sure that those bills are paid on time. The next most important thing, and this usually surprises people, it's the amounts owed. And what it means when we're talking about this is on a revolving account, meaning a credit card, is how much money you're carrying, or that balance that you're carrying month to month. So let's say you have a credit card with $1,000 balance, but every month you're charging it up to that maximum limit of $1,000. Even though you're paying your bills maybe on time each month, the credit bureaus don't like seeing that a balance get up to the maximum credit limit. The kind of sweet spot that you want to stay within is usually under about 30-35% of that balance. So same scenario, that credit card with $1,000 balance, you really never want to let that balance, $1,000 credit limit, you really never want that balance to go over, say, $300, $350 a month to really maximize your credit score. I think I get this laser pointer here. The next 3 categories are a little bit smaller, as you can see, not quite as important, but still something to keep in mind. Next one we have is 10% new credit. So that just means when your last account was opened. It's only 10%, and it's kind of tricky of what they might look at as far as new credit. So if you're concerned about your credit score and you want to work on it, make sure you talk to a mortgage loan officer, have them run your credit, and let them decide if it's worth opening a new account. You don't want to just go open up a new credit card or get a new car loan just because you think it might help your credit. You want to confirm that with your loan officer. In the next two sections, kind of in a similar spot, length of credit history just means how long you've had credit. Someone that's had a credit card with good history for 20 years is going to get a big boost versus someone who might have just opened one last month. And credit mix, 10%, so that's having a variety of credit cards, car loans, mortgages, maybe student loans. Again, it's a pretty small factor, so you don't want to just go open up credit just because it might help your score. You want to talk to your mortgage loan officer and see if it would be advantageous and if that's something that they would recommend. So the next section I'm going to talk about is income. You know, how much money you're making, and we'll see how much you can qualify for as far as that mortgage goes. A mortgage payment is made up, we use in the business an acronym PITI, as they call it, the PITI. That's your principal, interest, taxes, and insurance. So the principal and interest portion means that's the actual loan that you're paying back the principal balance plus interest. Taxes means your property taxes. Each month you're paying a little bit of property taxes, and insurance means homeowners insurance. So a side note on that, part of your mortgage payment is you're paying property taxes and homeowners insurance each month into what's called an escrow account. That's money that the lender sets aside and keeps in a separate account so that each year when your homeowner's insurance bill comes due or your property tax bills come due, you've already been paying into this account as part of your monthly payment, and then the lender uses that money to pay those bills for you. So no extra money out of pocket at the end of the year when property taxes or insurance might be due. That money is already being set aside each month with your monthly payment. So the main thing that a lender looks at when they're determining how much or how expensive of a home you can qualify for is they look at what's called your qualifying ratios. That is made up of your monthly income compared to what your monthly bills in the proposed new mortgage payment might be. This is maybe a little number heavy. We're kind of getting into some math here, but in this graphic over here, it shows someone with wages of $4,000. So let's say that means they have a salary of $48,000 a year. They're making $4,000 a month before taxes. And over here we have their debt payments. So they're trying to qualify for a $1,500 mortgage payment while they also have $400 a month in credit card bills, $300 a month in installment loans, meaning a credit card, or a car loan, or maybe student loans, and another line of credit for $300 a month. So these total debts add up to $2,500. The lender is saying this person has $2,500 a month of expenses compared to $4,000 of monthly income. When we look at that number, it would be 62% is what we're looking at as their qualifying ratio. So actually in this example, this person would not qualify for this home. I'm kind of jumping down, but we want to see this number between 41 to 45% or lower. Lower is always better. But in this example, 62% is too high. So we need to reduce this monthly mortgage payment because they can't qualify on it based on this scenario. We also look at what's called the housing expense ratio. That's just what this monthly mortgage payment is compared to your total income. It's an important thing that the lender will work at, but the most important thing they're looking at is the total debt ratio, which is explained in this example as your mortgage payment and all the different debts and liabilities that might show up on a credit report compared to your income. So in this $1,500 mortgage payment example, the lender would say, we can't quite do this. Let's look for maybe a less expensive home with a lower monthly payment, and that'll put you in a more comfortable place to qualify. And the third part that a lender is really looking at are your assets. So what does that mean? It's your down payment that you're putting down on the home and the closing costs that go along with the home. Of course, the lender needs to make sure that you have the money to pay for this. So the down payment, how much? It depends on what kind of loan program you qualify for. I'll point out just at the beginning, if there's any veterans here on the chat with us and you might qualify for a VA loan, that lets you put 0% down, which is the best program out there. But of course, you have to be a veteran to qualify for it. So most people are looking at conventional or FHA, which lets you put 3% down on a conventional or 3.5% down on an FHA. And that means that's of the total sales price. So let's say, just to make numbers easy, you're buying a home for $100,000. On a conventional loan at 3% down, 3% of that 100,000 is $3,000. So on that scenario, you would need to put $3,000 down as your down payment. Acceptable sources, this can be things like your checking and savings account, your bank accounts. You can withdraw retirement accounts, or if you have some stocks, things like that, you can liquidate that money, put it towards buying the home. You can get a gift from a family member. And of course, everyone's here with Live Baltimore, especially if you're looking in the city. There are tons and tons of grants, incentives, down payment programs out there, that we would look to add towards that down payment. And it depends on a case-by-case business basis. You'd want to talk with your loan officer and see which one of those programs you qualify for. The second part of the cash or the money required to buy a home are the closing costs. And here we'll break it down into 3 different categories. So first are the lender fees. That's the cost that you have to pay the mortgage company in order to get the loan. What that means is you're paying for things like the processing and underwriting for them to get the loan set up. Things like appraisals to make sure that the home is worth what you're paying for. Title fees, this is the settlement company or the title company. You might hear those terms used interchangeably, but they're the same thing. They're making sure when you buy the home that you are buying the home from the correct seller, that the title, the ownership is being transferred over correctly. And they also provide what's called title insurance, which just means if anything were to happen down the road, someone questioning or an issue with your ownership of the home, that title insurance would protect you and say that, yes, you are the owner. And the third section is third-party fees. The biggest expense of this, and usually the biggest closing costs, are transfer taxes. You can think of it just like a sales tax as when you're buying something at the store. There are some taxes that you pay towards the city or the state, depending where you're buying, to purchase that home. So now we understand what the 3 most important parts are that a lender is looking at. We'll talk a little bit about what the application process is. So first and foremost, you're getting the pre-approval. And the first bullet point I have up here is pre-approval versus pre-qualification. A lot of times you'll hear people use these like they're the same thing, but they are a little bit different. What you want to get is a pre-approval. A pre-qualification might just be you've talked to a lender, you told them I make about so-and-so much money, I don't have too much debt, and they'll say, okay, yeah, ballpark you qualify for, let's say, a $200,000 home. Okay, what you want to get is a pre-approval. What that means is you've had an extended conversation with a loan officer, they've pulled your credit, they've gathered documents, and they've said, yep, I've looked at everything, this is pretty much ready to go, you are pre-approved for this amount. This is important because when you go to actually put an offer in on a home, a seller wants to see that you sat down with the loan officer, you got your credit pulled, you turned in all your documents, you're ready to go with the pre-approval. What they don't want to see is the pre-qualification, meaning you haven't really done your due diligence yet. You're not really absolutely 100% sure that you qualify for the home yet. So part of this pre-approval stage, like I mentioned, is gathering documents. The most important documents that a lender is gathering are your pay stubs. They'll look for the 30 most recent days of pay stubs, W-2s and or 1099s for the last or most recent 2 years, tax returns for the most recent 2 years, and then they'll also ask for 2 months of your most recent bank statements. So with the pay stubs, W-2s, and tax returns, that's how the lender is verifying your income and calculating your income. And with the bank statements, as we talked about in this last slide, they're verifying your assets. So some tips for this: be prepared, be organized. It's going to seem like the lender is asking for everything under the sun. It's going to seem like a lot. So before you start working on that pre-approval, you want to make sure you have your finances in order. Maybe you need to contact your accountant, contact your employer, make sure these documents are available for you and that you can provide them to the lender. Be ready to answer questions. Just like I mentioned, it's going to seem like the lender is asking you for every piece of financial document that you have. They're also going to ask you a lot of questions that might seem personal. I promise they're not trying to invade your privacy, but they have to take a complete and full loan application, so they have to make sure they get the full picture. So just be ready to answer those questions. And then importantly, what not to do after this loan application. You want to keep your financial picture the exact same. So what does that mean? It means don't change jobs, don't change employers, positions. We have your income figured out based on your current job and employment, and as well as your credit report. We pulled the credit report. We want to make sure that stays consistent. So don't open up any new credit cards, car loans, don't make any new major purchases, or in fact, major purchases or anything that might affect credit. Seems to be frozen. Here we go. So once you get into that pre-approval stage, you're going to want to start shopping for a lender. Over 50% of home buyers don't compare lenders. They just stick with the first one that they happen to run into. When doing this pre-approval process and starting to explore talking to different lenders, I would recommend talking from anywhere from 2 to 3 lenders. By then, you should start to get a pretty complete picture of what other lenders might have to offer and make sure you're getting a good deal. You want to ask your lender what loan programs you qualify for, what your interest rate will be, what your cash to close will be. You'll want to get an estimate, make sure you're seeing the full picture, make sure you're getting the best financial options out there. Once you start to get some loan estimates from your lender, spend some time getting to know them, it really comes down to, if numbers and everything are pretty comparable, it comes down to your comfortability with that lender. You're going to be spending a lot of time with them over the next several months as you start shopping for a home, purchasing a home, and the entire process. So it's something that you want to know that you get along with and that you communicate with well. So once you find that home and you put an offer on, this is the mortgage process of that home. So you've been pre-approved, you've gone out shopping, you found the home that you want to purchase, you put an offer in on it, and your offer is accepted. Awesome. What happens now is your loan in the file that you put together with your loan officer goes into processing. So from here, you'll be working with the loan processor as well. They'll review everything that's been done so far, check to make sure if there's anything else we need to start to get together, and they'll put everything together in a nice, neat file, make it nice and pretty, perfect, and they'll submit that file to underwriting. We want to make sure it's a perfect file when it goes to underwriting, because keep in mind, you're spending a lot of time with your loan officer, you're getting to know each other, the loan officer knows you as a person, but when your file gets to underwriting, they don't know you, they don't get a chance to speak with you, they're just looking at the numbers and what's on paper. So that's why we put everything together, nice and neat, put it together, send it to underwriting. They're looking over everything, making sure they agree with our income calculation, making sure that you have the assets to purchase it, making sure you meet the program requirements. And once they check all those boxes, your loan is approved. The underwriter might ask for some follow-up documents here and there. They might say, hey, we need an updated pay stub, or can you provide a little more information on this? And once we clear all those questions, that means you get the clear to close, or the final approval. Once you get that, you're ready to go to closing. That's when you send the final funds, or the money, the cash that you need to close. It depends on what kind of title company or which title company you're working with, but they typically ask for a certified or cashier's check, or for you to wire the money over ahead of time. Once you send the money over and you get to the closing table, you'll be signing all the legal documents. It seems like a lot, promise me, you'll get through it. And once that's said and done, you get your keys, the fun part. And that settlement, all in all, it usually takes maybe an hour, hour and a half, give or take. Just depends how many questions you have and the speed of what's going on. And then post-closing, once you're settled in your home, you're moved in, everything looks good. That's when you can start to apply for some tax credits, set up an auto pay in your first payment. So, and another really fun thing about the mortgage is whenever you close on a home, you get to skip 1 month of payments. So let's say that you buy a home now and you close on it, let's say the end of May, you get to skip June, and that first payment wouldn't be due until July 1st. So whenever you close in that month, it skips the next one, and then it's due on the 1st of the following month. All right, and so from here, I just have a few kind of tips for the loan process. 3 to 12 months before you're ready to buy, you want to complete your home buyer education. Live Baltimore is a great resource for that. On their website, they have the list of all the housing counselors that are approved in the city. To use any of the city-specific grants and programs, you need to have your home buyer education completed and your housing counseling certificate before you put an offer in on a home. And this certificate is good for 1 year, so it's great to just go ahead and get that knocked out in the very beginning. 2 to 3 months before you're ready to start looking, that's when you want to start looking for a lender and getting pre-approved. You want to do that early on. A mistake people make from time to time is they get pre-approved and they get under contract on a home, and then they start shopping for a lender. You want to make sure you get all that done ahead of time, so that by the time you find a house you like, you know what lender you're going with, you know which loan program you're using, and you're ready to go. Pay down balances on revolving debt or credit cards. That's always a good practice. Always something important to keep in mind is keeping those balances low, like we talked about. I wouldn't worry too much about feeling like you have to get your balances all the way down to zero unless your loan officer tells you to, but you definitely don't want to increase them. And as we mentioned, you don't want to open up any new credit, and that means credit inquiries as well. You don't want anyone pulling your credit during the process. And once you're ready to make an offer, you want to review all your different loan options, make sure you're comfortable with the numbers before you're putting that offer in. So that means your lender provides you with a detailed loan estimate. You're looking at what your monthly payment's going to be and what your cash to close is going to be. That's usually the two most important things, that we all care about is what's my monthly payment, how much is it going to cost me out of pocket to get into the home. And then you want to talk to your lender about a realistic time frame. So if you're not using any grants, incentives, or special programs, a typical contract or offer on a home, it takes about 30 days from when your contract or offer is accepted until you get to the closing table. However, if we're using incentives with the city, we usually like to give ourselves a little bit more time just because there's more parties involved. We might push that out closer to 45 days. All right. And then one more slide on tips. Once you're under contract, you'll want to pick a title company. Just like you want to interview different lenders and pick which lender you feel comfortable with, you'll also have the ability to pick your title company. Most of the time, the real estate agent will provide a recommendation for the title company, and most people will stick with that title company just because it's a smoother flow, but you do have the option to choose who you want to use as your title company. You also get to choose who you use for your homeowner's insurance. So once you find the home that you want to purchase, you'll want to talk to a homeowner's insurance company to start finding out what your insurance will be for the home. I usually tell people just to start with whoever might be doing your car insurance or who you currently have a relationship with. It's worth getting a quote from. But just like a lender and a title company, you get to choose. So feel free to get multiple quotes and find the policy that works for you. Once you're under contract, the lender might ask for some updates of documents here and there, updated pay stubs, bank statements, what have you. Since we are on a timeline and there's a specific contract or settlement date that where everyone's working to meet, if your lender, title company, or realtor asks something for you, make sure that you can get it to them as quickly as possible. That means being proactive, staying organized, and staying ready. If you're ever unsure about anything, ask your lender, ask your real estate agent. They're your advocates. They're there to help you. Communication is key. The last thing anyone wants for you to be is confused or unsure about anything moving forward. They're on your team. They're on your side. So you want to make sure you pick a lender and a realtor that you get along with and you feel comfortable asking these questions with. So that is the end of my presentation. Like I said, I usually like to make it a little bit more interactive, so we might have gotten through that a little bit quicker. But if everybody has been putting some questions into the Q&A box, I will turn on my video and we can start to answer some of these questions that everyone had during the
All right. Great job, Chase. Thank you. Right on time, and we did have a few questions come throughout the chat there. I'll just start with the most recent one that just came through because I think you were talking about grants and incentive programs for a minute there. Ashley asks, is there a maximum amount of money that you can have in your savings before you become ineligible for any of the grants?
Great question. It's going to depend on each individual or specific grant will have different requirements or different restrictions. For the most part, the Baltimore City grants and incentives aren't as concerned about the assets that you might have. But for example, the Maryland Mortgage Program, which some people might have heard of, is basically a state program that you can combine with the city grants and incentives. This state program does have an asset restriction. They don't want you to have more than 20% of the sales price in assets, and they mean liquid assets, just basically sitting in the bank. It's okay if you have them as, for example, like a retirement account, but the state does limit it that if you have more than 20% in your bank account, you're not eligible for their programs. So the first step I would say is do a loan application, get with your loan officer, figure out which ones you qualify for, and they'll be able to tell you which ones you can use, which ones you can combine, and what makes the most sense.
Cool. I'll take this time then to put a little plug in there for our next class coming up in May. I will be teaching the next virtual 6 o'clock session. That was where we dive deep into the many incentive programs and tax credits that are available in the city. So you can find that on livebaltimore.com/events to find out when that is and to register for that one. So cool. We got a couple more questions coming in. That's great. Are there opportunities in Baltimore for home ownership with condos?
Yeah, absolutely. Being a city, there are absolutely condo buildings and condo buildings for sale. You'll want to make sure you're looking, if you're on Zillow or one of those websites, making sure you're looking at ones for sale that are just for rent. Some buildings might have some that are being rented out for sale. For the most part, just about all the programs or the general programs we were talking about, you can use a condo on. Some of the grants and incentives cannot be used on a condo. But in general, buying a condo is just about the exact same process as we talked about. You just cannot qualify for all the incentives. So it's something to talk with your loan officer, compare numbers, see if it makes sense, and if it's something you want to do. And I will add one side note that I typically run into with people when we're looking at condos is be prepared for a higher monthly condo or HOA due. So if a lender tells you want to look in, let's say, a $200,000 price range to keep your monthly payment, where you're looking to keep it or what you're comfortable with, a condo might look like it's less expensive because the sales price is lower, but most of the condo buildings have HOA or condo monthly dues that range anywhere from, could be a couple $100 as high as, say, $500 per month. So just something to keep an eye on as you're potentially looking at condos.
Here's another one, Chase, from Jessica. How many different city and state incentive programs can be combined?
Great question. It just depends how many you can qualify for. There's really not a restriction saying there's no rule saying you can only have 3, that's it. It just depends which ones you qualify for. Some can be combined and stacked together, others can't. So it's just figuring out how many you can get and how many of those you can combine. I've worked with people in the past that have gotten the 17,000 Johns Hopkins live near your work, 10,000 vacants to value, and some state money on top of it for another 5,000. So that's not the norm. Don't go into it expecting that everyone's going to get that 30,000, but it just depends what you qualify for and what we can get you into.
All right, here's a good one, Chase. Van has applied for a pre-approval. The lender that he was working with suggested to pay down some debt. He's got credit cards, HELOC, parents' loan, and mortgage. He wants to know what is most beneficial to pay down to help probably improve his score.
Great question. It's tough to say exactly without seeing a specific credit report. Most mortgage lenders should have access through the resource, the tool that they use to pull credit reports, should have these tools available. It's called a what-if simulator or a credit analyzer, but a lender should have the ability to take a specific credit report, basically run these simulations or this analysis that will say exactly what you should do or pay down first to improve your score. So if you're already working with the lender, I would ask them about that. So it's difficult for me to tell you, on a case-by-case basis without actually seeing the credit report. I'll say just in general, it seems that typically lower credit cards seem to improve scores the most. But again, you definitely want to have your score, your credit report pulled by a lender and have them run those tools so you can get a specific answer to each scenario.
All right, and we did get a question about the trolley tour. So a lot of people have been asking us. We did have one of our major events from Live Baltimore scheduled for May 9th, the trolley tour. If you are not familiar with that, what it is a 3 time per year home buying event where we give away 30 different $5,000 incentives for home buyers within Baltimore City. The answer to that is when we are rescheduling it is going to be TBD. It is going to be virtual. We are in the works working on putting together almost a virtual trade show where you'll be able to view houses that are for sale. I don't want to give away too many details as we still work towards that, but we'll be announcing a lot more details about that probably mid to late next week. For the time being, though, if you have not registered and are interested in possibly getting $5,000 towards a home, I would recommend that you go to livebaltimore.com/events and register for the Eventbrite on the trolley tour Eventbrite there. That way you'll be notified as soon as we have all of the details finalized for that. So that's for our trolley tour. Alexandra wants to know, are there any benefits or programs for city teachers as far as home ownership? You can extend that into just any city employees too, Chase.
Yeah, great question. As I just mentioned, a city teacher as well as city employees, there is a $5,000 grant for Baltimore City employees. Usually I want to say this, guys, it's 6 months that you've been on the job typically before you can qualify for that. But yes, to answer your question, city teachers and city employees for that matter do qualify for a $5,000 grant.
I'm going to add to that currently the city employees incentive is out of money. They ran out probably in early February, I think, for the fiscal year, which resets July 1st. So if you're thinking about doing anything with that, you want to do your homeownership counseling first. You'll probably want to attend our webinar in May when I go through all of these incentive programs and what you need to be eligible for those. But they will be replenished come July 1st. All right, here's a fun one. Chase, how does it work if you want to get a mortgage on a houseboat?
Great question. Interesting question. For something like that, you would want to ask your bank that you do banking through, or maybe a credit union, because a houseboat is not what you can get, what we would call a traditional mortgage. So when we were talking about this, I mentioned a VA loan for veterans, an FHA loan, which is a government-backed loan, or a conventional loan. Still apply for houseboats. There is financing out there. You can get that for a houseboat, but like I said, it's not what we would call a true or kind of a traditional mortgage. So typically, it's kind of something more specific like that. Unique situation. A credit union might have a better option for that.
All right, so Chase, talk a little bit about, say somebody already has a mortgage and has a house that they need to sell. How does it work qualifying them for another mortgage?
Good question. It depends on when that your current home is going to be sold. If it's going to be sold before you settle on your next home, that means that qualification is essentially the same. There aren't too many hoops that we jump through. But the tricky part is if you don't have a contract on your current home that you're selling and you're trying to buy the next one, if your current home is not going to be sold before you settle on the next one, typically that means the lender needs to qualify you with both mortgage payments. So that can be tricky. Even though you're not going to be making both mortgage payments, long term, or that's not the plan, the lender might have to qualify you with both payments. So if you have a home that you're going to sell and buy the next one, I would talk with your loan officer. They can analyze exactly what you can do with potentially qualifying with both payments, or if you need that home to be sold beforehand. But it is a case-by-case basis, depending what your plan is and what you can qualify for.
Great. Back back to the incentives. Everybody's got a lot of questions about those. Talk a little bit about the process for applying for these grants and these incentives. How does it work? Does the customer have to go do that ahead of time? Do you help them with that? How does that work? Christina and Darrell want to know.
Perfect. Great question. As far as what you do, you have to take, like we mentioned, that home counseling course. Make sure you get your certificate before you put a contract or an offer in on the home. Depending on the grant, some of them do it a little bit differently. You might need to go to the city office to apply for something, or you might have some things that you need to turn in. But the good news is really the majority of the legwork for applying for these grants and getting them approved is on the lender. So that's why it's very, very important if you are thinking about using or you want to take advantage of some of these city programs, is that you work with one of the lenders, one of Live Baltimore's partners, or one of the lenders that are familiar with these programs. So as I said, the lender is really doing most of the work, getting these grants submitted and approved. And you want someone that's familiar with that process, because you are jumping through some hoops, working with the city, and it can be kind of tough if someone's not familiar with it. So partner with Live Baltimore. There's lots of great lender partners with Live Baltimore, but you definitely want to work with someone that has done that before, is familiar with the grant process.
All right, Chase. When it comes to paying down revolving debt, any other credit cards, would it make sense to take out a new credit card and do a balance transfer if that one has zero interest? I guess talk a little bit about what you recommend to help best improve your scores or improve your debt situation quickly.
Sure. I like the train of thought, thinking outside of the box, but you're not going to want to open up a new credit card and do a balance transfer. Typically, you want to avoid opening up any new lines of credit while working on your credit or going through the mortgage pre-approval process. To pay down that revolving balance or to show the lower balance, really the only way and the best way to go about it is just paying down the balance, with money out of your bank account or putting cash towards it. Because what the credit bureaus are looking at is they want to see that debt or that amount owed going down. And while a balance transfer might help you as far as paying interest temporarily, on the credit report, the credit bureaus are just going to see that balance transferred from one card to another. So it could help you out as far as the interest paid, but it's not going to have an advantage or impact or to your credit score if you were to just pay down the balance. And I get that, depending what those balances are, everyone's situation. If the lender tells you need to pay down your balance, that doesn't mean you can just go out and do it tomorrow. It might take a little bit of time, but that's really the best way to go about it, is just paying down the balance on your own.
All right, Jessica has a two-part question. How does gifted money work with pre-approval? What do you need from that? Is there restrictions on it? Those kinds of stuff.
Perfect. There are restrictions on who you can get a gift from. It needs to be a family member, and it can't be, can't be the seller. I mean, they want to make sure it's not the seller that's giving you a gift. It needs to be a family member or someone with a close relationship. And it's important to note, if you are getting a gift from a family member, to prep them for what they're going to need to provide. So depending on the loan program, it can be a little different what they're asking for, but be prepared. Let's say you're getting a gift from your parents. If they're giving you, let's say, $5,000, the lender is probably going to ask you to see your bank statement showing that $5,000, enter your account. They might want to see the cancel check or the transfer from their account. And this is, some people sometimes get uncomfortable with this, but if your parents gave you $5,000 from their bank account, the lender's going to want to see their bank statement as well, showing that $5,000 leaving their account. So you want to prep them with that ahead of time. And again, it's not the lender being nosy or trying to see, what's going on, but what they're looking for when we're talking about what assets can be used towards purchasing a home. Really, at the end of the day, the lender is just making sure that you're not, let's say, borrowing money to use as a down payment. So they'll ask for the bank statement from your parents to make sure that it is their money. They didn't go take out a loan or borrow money to then essentially lend to you. So you'll need those documents, and they also will sign or fill out what we call gift letter, which is just them stating that, yes, we are giving you this $5,000 to purchase the home. It's not a loan, it's a gift, basically no strings attached. This person doesn't owe us this money back. It's for the purchase of their home.
Cool. Part two was regarding cosigners. How does that work if you need somebody else to cosign on the loan?
Great question. A lot of the state program and a lot of the city incentives don't allow for cosigners. So that's something to keep in mind with. But if you're not using some of those programs, what a cosigner means, say it's just you as an individual purchasing a home, you could ask a family member, use the same example, let's say mom and dad, to co-sign on the loan. What that means is we're then using their income to help you qualify for the home. And as well as their credit report gets mixed in, or we're looking at their credit score, their different debts and liabilities. It's basically like adding someone else to the loan. We're counting their income, but we're also counting their debts. But if mom and dad, have a higher income, they might help you qualify for more. And what that means is we can set it up so that they're part of the loan, but not necessarily entitled to the home. So you still own the home, but they've co-signed on the loan, meaning they're adding their income and their credit to the profile to help you get approved. As I mentioned before, as far as credit scores go, it doesn't help from that aspect. Let's say you have a 680, but mom and dad have a 740. The lender has to go off of whatever the lowest score is on the loan. So having a better credit score doesn't help average it out or add anything to that. It's just really if we want to help add their income to help you qualify for more, if that makes sense.
Chase, we talked about the income slide. We were talking about gross income and that. How does it work qualifying wise if you are a contract employee and you get 1099?
Great question. So, and I'll kind of backtrack from that. The lender is always looking at what we call gross income, or money before taxes, when you're an hourly or W-2 employee. So that makes it pretty easy. In that example, $4,000 a month, if they had a $48,000 a year salary, we're just dividing that by 12 and saying, okay, $4,000, that works, that's easy. Or if it's hourly, we're just going to take an average and figure out, what's the average month look like before taxes. It gets a little bit trickier if you're a 1099 or self-employed borrower or buyer. In that case, we're looking at your tax returns to figure out how much money you're essentially claiming on your tax returns. So anyone that's 1099 or self-employed knows this. You have your income that you're putting on your tax returns, and then you get to write off your expenses, things like depreciation, costs, or goods, services you had to purchase to run the business. When we're qualifying someone that's self-employed or 1099, in that case, we're looking at the net income. So after the expenses that go into running the business. I mentioned depreciation. That's something as a lender, and that's not a true cost that you're actually, out the wallet, out of pocket expense. We don't have to count that against you, but most of the expenses that a 1099 or self-employed borrower is claiming, we do have to deduct from your income and go off of that net amount at the end.
How long does a pre-approval good for?
Good question. The credit documents that a lender gets, if we're kind of getting behind the scenes, are technically good for 120 days or 4 months. But really, a good rule of thumb, and most lenders will do this, is every 30 to 60 days, they'll want to get updated documents. So once you get that pre-approval, I'd say 30, 60 days, you can feel pretty comfortable about having that pre-approval amount until you need to send in updated documents. So nothing too complicated, but if you do, let's say your pre-approval in May and July rolls around, the lender might ask you to get some updated bank statements, updated pay stubs, just to make sure everything's still in line to essentially renew that pre-approval.
Cool. What about when you're purchasing homes either from an auction or foreclosure, short sales, any distressed homes? What are some things to consider there?
Yeah, that's as you start to do some home shopping. This comes up often because you might be poking around on Redfin, Zillow, or one of those websites starting to look at some homes. You might notice that there's some very, let's say, underpriced or undervalued homes that might be foreclosures, short sales, or auctions. you are eligible or you're able to buy these homes. Just some things to kind of keep in mind as you look at them. A short sale or foreclosure have a much longer timeline as far as how long it's going to take you to complete the purchase and actually get into the home. So as I mentioned before, it could be anywhere from 30 to 45 days on a normal home, with a buyer and a seller to complete that closing. We call them bank-owned properties, which would be a short sale or foreclosure. Those can take from a couple months, 3, 4, 5, up to 6 months. There's a lot of extra steps, legal work involved as far as the bank approving the short sale or the foreclosure, making sure that the current owner was given the proper notice that everything is being done by the book. So it usually takes several months to purchase one of those homes. And another thing to keep in mind is typically the closing costs are much higher or decently higher on those types of homes. I mentioned the biggest closing costs typically is transfer taxes. On a normal sale, that's split between the buyer and the seller. On a foreclosure or short sale, they typically are not. You're typically responsible for paying the entire portion. And most of the time, the bank on a foreclosure or short sale will have, they might call it a loss mitigation fee or short sale consulting fee, whatever it might be, typically for a few extra $1,000 as an added on closing cost. And the same applies for auction properties as well. It's tough. It seems like a great deal because you're getting it for a lower price, but there are extra hoops to jump through on the short sale and foreclosures. And as far as the auction goes, you typically can't get an auctioned home if you're getting financing. 99 out of 100 times, the people that are buying these auctions are cash investors. And the reason for that is typically an auction, they're holding that auction because they want to get it sold as quickly as possible. As I mentioned, a mortgage or the financing process could take 30, 45 days, or if it's sold by the bank, several months. When a property is being auctioned, they're really just looking for someone to come in and say, I have the cash right here, I'm ready to pay, whatever that price might be. So it's something you can look at, but really auctions aren't usually feasible if you're getting a mortgage or obtaining financing.
All right, Chase, talk a little bit. It's crazy time now. A lot of people are out of work. What have you guys done, either yourself or First Home? Talk a little bit about what you're doing differently during the pandemic, if there is any differences.
Sure. One of the biggest, these are obviously tough times for everyone. I will point out or make note, if you've been furloughed or hours have been cut, that does affect what kind of income we can qualify with and how much of a home you can qualify for. So even if you've been making a certain amount of money before everything started going on, if hours have been cut, until the hours resume back to normal, we do have to go off of what your current averages or the current work week looks like. And that's not a First Home thing, that's across the industry. We've received rules or guideline changes that we need to look at it like that. Some other things are lenders might be updating documents more frequently. Like I mentioned, the pre-approval is good for a couple months. We're seeing most lenders update that even more frequently just to make sure, because these are such uncertain times, that things aren't changing. We've also seen some of the credit guidelines tighten up a little bit on some programs here or there. Some lenders might be increasing their minimum credit scores until everything settles down, or they might be requiring buyers have what they call reserves, which would mean, if it costs, let's say $10,000 is the cash to close you need to get into the home. Some lenders might say, we need to see that you have more than just that $10,000 to close. We want to see that you have some reserves or some money left over to close. So there have been some restrictions, some changes like that. Are really the biggest things. Some of the I'll call them one-off loan programs we started to see disappear. Not anything I would assume most people here are interested in, but some like the investor programs we're seeing disappear or not be available for the time being. We expect everything to come back, once life starts to get back to normal a little bit. But yeah, it's worth sitting down with your loan officer and making sure that you still qualify, that the programs are still there. But for the most part, fortunately, knock on wood, businesses is relatively moving on not too deeply impacted.
All right, we couple more here. Thanks for everybody sticking on and
Sure.
for all these great questions. We're going to go through a couple more. Amber asked about the time. So we talked about how you can improve your scores by paying down some debt. She wants to know how long does it take from the time you make a change on your report to when it is reflected in your score? How does that work?
Good question. The credit bureaus update once per month. So typically to see those changes, it takes about 1 month. Depending on circumstances or what's going on, a lender might have access to what's called a rapid rescore. I'll say it's not too common to use that, and it's really only used if it's a dire situation, and the reason is it's expensive to do a rapid rescore. It's usually several $100s to update a credit score quicker than 1 month. So like I said, unless you're already maybe under contract and you need to get the score up by a certain date, typically, just about 9 out of 10 times you're going to have to wait the next month to see that score update.
All right, let's see what else. We've got a couple ones here. Can you talk about the escrow accounts again and how specifically that relates to your mortgages, to your mortgage?
Sure. So just to recap, the monthly payment, we call it PITI, is what makes up that monthly payment. The principal and interest, the PI portion, is actually paying back the loan itself. And then part of that mortgage payment is also the taxes, meaning property taxes, and insurance, being homeowners insurance. So just to pick a round number, I'll say your mortgage payment, your total monthly payment might be, let's say, $1,000. Maybe 700 of that is paying back the principal and interest. 200 of that payment, let's say, is property taxes, and 100 of that is your monthly homeowners insurance, making up that total $1,000 payment. So what that means is, in that example, $200 of property taxes and $100 of homeowners insurance is going into an escrow account each month. The escrow account is this account that the lender holds separately as you're making your monthly payment. Principal and interest is paying down the loan, and then money, that 300, the property taxes and the insurance, is being set aside each month into this escrow account that the lender holds. And so each month it gets bigger and bigger and bigger, and they have it timed out so that once it's filled up by the time the property taxes come due, and they're going to take that and say, all right, we have $1,000 already saved up, set aside in this escrow account. Boom, here's the property tax bill due, that's paid for. And the same thing each year when your homeowner's insurance bill comes up for renewal, or that amount is owed again. The lender has already saved up enough money in the escrow account that you're paying into each month to pay that bill for you. And lenders do that because they want to make sure that those bills are paid each year, because they are very important. They don't want there to be a tax lien on the home. And of course, they want to make sure you're up to date on your homeowner's insurance. So, worst case if something were to happen to the home, they want to make sure that the insurance is there and that you're taken care of. It's kind of a strange concept to wrap your head around, but if anyone has any more questions about the escrow account, we can keep jumping into that.
All right, great. Just one more here. Without opening up new credit cards, what are some suggestions on how to improve your credit score? What can you do?
Sure. Most of the time when I run those credit analyzers or simulators, it's almost always has to do with paying down balances on a credit card. Sometimes another common thing is it might ask you to open up a new credit card if you don't have much of a history, or let's say you don't have any credit cards. If you have some outstanding or late balances, that often helps, or maybe some outstanding collection accounts. It's very, very important that you talk to your mortgage lender and have them run these tools, because in some cases, some rare cases, paying an old bill might actually hurt your score. So it's just something to keep an eye on. You want them to make sure that you're doing everything right. And another important thing to keep in mind is not to close any credit cards. The lender might say, pay down this balance to zero and leave it at zero. That means pay it down to zero and leave it. Don't close the account, because essentially what happens is once you close a credit card account, it's like it disappears and you're not getting the benefits of that account existing anymore. it's these active trade lines. So even if it has a zero balance, if it's an active credit card, you're still getting the benefits or the score increase for having that credit card open. But if you close it, you'll lose that benefit. So whenever a balance is paid down to zero, just make sure you still keep the card open. Don't close any cards.
All right, and we got one more that just came in, and it's about credit. So if somebody is getting an offer from a card, say has zero balance, but another card they have has $1,000 on it, how does it negatively impact the loan process if they were to transfer balance to the new card?
I mean, it shouldn't impact the process as far as your qualifying amount, because it's the same debt or same balances that are still owed. It could have an impact on your credit score. Again, it's difficult to say without seeing the full report and everything else that's going on. Again, these credit, I know you're probably looking for more detailed or specific information, but I'm just hesitant to give exact or specific answers without seeing a full credit report. When a lender runs your credit report and they work these tools, I mean, it's unique for each scenario, each credit report. So it's really important to talk with the mortgage loan officer, have them run that simulator. Because like I mentioned, sometimes paying down an old past due account helps. Sometimes it hurts it. So for that reason, I mean, I'm hesitant to say exactly one way or the other, but I would definitely talk to a loan officer about that.
All right. Well, I don't see any more questions in the box. Hopefully, if everybody's still with us, we want to say thank you very much for joining us tonight. We hope that you got some great information from Chase. Hopefully, you're better suited now to go out there and buy your house within Baltimore. Thank you again. If there are any questions, you can reach out directly to Chase. His number there and his email are on the screen. With that, thanks for spending time with us, and we will see you again. Take care.
All right. Thanks, everyone.